Hi, I'm Wayne Rochelle. I'm the CEO and Chief Investment Officer of Genus Capital. And with me is Mike Thiessen, our Director of Sustainable Investing. And today we're going to do a first quarter review for our fossil-free and sustainable clients. Well, it was quite the quarter. The quarter started off in a real positive manner. The economy was turning around, the markets were doing well, and boom, we got hit by two black swans, the pandemic and a price war in the oil sector. And from that, we're going to get a recession, obviously. The economy is going to shut down for 2 to 3 months and then try and reboot. And what we're seeing from a forecasting perspective is Q2, economy shrinks by about 10%, probably another 2 or 3 in Q3, and then starts growing maybe 3 to 5% in Q4. We don't see the economy really getting back everything it lost until early 2022. That's our best guess. It's never been done before. We've never had a shutdown and a reboot within 2 to 3 months, so we don't know what we don't know. The market panicked and plunged 35%, most equity markets around the world. Oil went below $20 and the Canadian dollar slumped to 68 cents as we were hit hard because of the oil impact. The Federal Reserve and other central banks came to the rescue very aggressively. They learned a lot in 2008 and they applied that in this case here in this scenario. They came in, they brought rates to zero very quickly. They went to quantitative easing infinity. They're buying corporate bonds, municipal bonds. They're buying any risk out there, they're buying it. And that's helped turn the markets around. We've had a 50% retracement in the markets over the past couple of weeks, which we're really liking. But still we have to go through the hard part of the downturn in the economy and a downturn in earnings and get through that. So, we're hopeful, but there's still a lot of things we have to deal with and the mess has to be cleaned up going forward. So Mike, how did the fossil-free and sustainable side of things do this quarter? How did this impact them?
So of course, the fossil-free funds were heavily impacted by the pandemic. It's hard to really avoid the pandemic, but thankfully for the fossil-free funds, we're not holding oil and gas companies or companies with fossil fuel reserves. So that one black swan didn't affect us. Actually, relative to the market, it actually helped us. So within these portfolios, we did have to make some large adjustments within the first quarter. We are already underweight energy, not having any oil and gas, so we didn't have to make any big shifts there. But coming into the first quarter, we were actually quite bullish on the economy and on the market. A lot of our economic signals were telling us that things were looking up. So we were overweighting equities in portfolios. We were buying more cyclical types of sectors and types of companies within our portfolios. But once we saw that the pandemic was starting to come out of China and start to hit other areas of the world, we quickly made a shift within our portfolios to sectors that we thought would do better in kind of the new paradigm that was coming out. And we got more defensive as well because we knew that this would heavily affect the economy. So we started to move into sectors like information technology. We had a big increase in our weights in IT. Also healthcare we thought would do well in this new paradigm. And we decreased certain sectors like industrials, like financials, because we didn't think that highly cyclical sectors like that would do as well with the economy contracting due to the pandemic. And we thought especially financials in Canada would have a rough time because financials in Canada are going to be hit by the pandemic, plus they're going to be hit by the oil crisis. Even though we have fossil-free accounts, the large Canadian banks are still going to be hit by this. So we reduced our weighting there, especially among smaller Canadian financials, because we thought they would be possibly hit the worst by this. And so our sector weights remain quite similar to what they were on March 15th when we were kind of done our switches, but we have lowered the cash levels in our portfolio since then.
Okay, thanks, Mike. Now, before we get into sustainable metrics and our performance, we thought we'd just do a quick review of what is fossil free. Uh, our clients came to us 7 years ago and said they didn't want their money or capital contributing to climate change. And so the mandate was we divest from companies that are involved in extraction, processing, and transportation of oil, gas, and coal. And also, we want to will lower the carbon emissions 70% versus the benchmarks. And why do we do this? Well, we do this for a couple of reasons: for value, from a value perspective, and from a financial perspective. Many clients, they want their portfolios aligned with their values, and so if their brand or their background is associated with fossil free, they want to see that in their portfolios as well. On the financial side, is the big concern there, of course, is you've heard the term stranded assets. Mark Carney from the Bank of Canada, Bank of England's been talking about that for years. And the issue there, of course, is if we all do comply with the Paris Accord, that'll leave half the fossil fuel reserves underground and stranded. And that's going to have impact on values for oil companies, for financials, insurance companies, etc. So that's a bit about why we all do what we do here. Looking at some of now we're more than fossil free. We also include other screens besides fossil free. Maybe Mike, you can go over some of the screens we employ besides fossil fuels.
Sure. So we exclude certain products that are controversial, or products that a lot of our clients have told us that they don't want in their portfolios, that don't align with their values. So products like weapons or gambling or tobacco. One of the new screens that we just implemented was factory farming, because some of our clients were concerned about factory farming. And then we also rank companies based on environmental, social, and governance factors. And then we cut out the companies that are the poorest in these areas out of our universe. So we're not able to invest in those. And beyond this, we also don't invest in companies that are involved in controversies within the companies. So they may have controversies around their labor force and how they're treating their labor force, or maybe controversies around the communities that they're working in. And we don't want to be investing in companies like that either. So we cut them out of our investable universe.
Okay. And how we compensate for removing energy stocks from your portfolio, based on our definition, is we actually intend to hold more information technology, more financials, more consumer discretionary, and more telecom stocks. And I just would say, from an investment perspective, over the next 10 years, I would rather have a stake in technology and not in energy stocks. So I think that's a solid bet to take over the next 10 years, I would say. Okay, let's go over the sustainability metrics, looking at the fossil-free dividend equity fund, the fossil-free Can Globe, and the fossil-free high impact equity fund. Mike, over to you.
Okay, so in terms of fossil fuel reserves, of course, for our fossil-free funds, we don't have any reserves, which has really helped us during this time period and helps us against stranded asset risk, as Wayne was talking about. But the benchmarks do have significant fossil fuel reserves. You can see one of the benchmarks has 275 million barrels of oil equivalent in terms of reserves. So it's very significant relative to our zero for our fossil-free funds. And then the middle bar graph is carbon intensity. So carbon intensity is the tons of carbon emissions per million in sales. So this can really vary from a coal utility that might have 10,000 carbon intensity, so that means 10,000 tons per million in sales, all the way to a tech company that might have 15 or 20 tons per million in sales. So there's a big range. But you can see that our fossil-free funds all have under 60 for average carbon intensity. Even the dividend fund has down to 33. So quite low carbon intensity versus the benchmarks that have 100 or 240 and 165. So a big difference there, and we're committed to being significantly lower than our benchmarks. And then on the right, we have ESG ratings, so environmental, social, and governance ratings. And these are ratings that are put out by data providers like MSCI. And so our funds have 6.8, 6.4, and 7.6 rating out of 10 versus our benchmarks that have 6.1 rating. And our fossil-free high-impact equity fund has a 7.6 rating, so that's the highest rating out of our funds. And really, it makes sense because that fund is meant to invest in companies that are most impactful and are making a difference in the world. So they're going to have a higher ESG rating. So also when we're measuring impact within our impact fund, we look at the percentage of revenue that each company is making in that fund that is coming from a product or service that is making an impact. And we look at impact if it's linked to one of the 17 Sustainable Development Goals. These are goals that were set out by the UN in 2015, and they really vary from things like quality education to clean and affordable energy to climate action. There's a wide variety of these goals, and they're meant to be goals for organizations, governments, and businesses to try and accomplish to make the world a better place. So we want the average company within our impact portfolio to make 50% of its revenue or more from impactful products or services that can be linked to a sustainable development goal. So we have some companies in there like Vestas Wind that might have 100% of its revenue coming from impact, and then maybe some tech companies that might have an energy efficiency project, maybe 20 or 30% is coming from impactful products or services. But on average right now, within that fund, the average company has impact revenue of 61% versus 12% for the MSCI World, which is our benchmark. And so our fossil-free high impact fund not only is making a lot of impact, but it's also in the first quarter really, excuse me, really been our star performer for performance. So this fund is investing in companies that have solutions to some of the world's biggest problems. So in times like this, with a pandemic, or if there was large issues having to do with climate change in the future, I believe that it would also perform really well. It's really a hedge against these big world issues because we're investing in companies that have solutions to these issues. So in January, this fund was able to outperform the benchmark. In February, it slightly underperformed the benchmark as the market started to go down. But in March, this is when it really outperformed. It actually was up for March versus the benchmark that was down about 8%. So in the first quarter, our fossil-free high-impact fund was down about 3.6%, whereas our benchmark was down about 13.5%. So it beat our benchmark by almost 10%, which is very significant. And we really see it as a hedge against climate change and other big world problems in the future. So looking at more performance, this is our fossil-free CanGlobe equity fund, really our growth strategy for fossil-free. And this is our 7-year performance, almost 7 years now. And you can see that performance has been up and to the right until this last quarter. Of course, there's been the pandemic, but still we've been able to outperform the benchmark over the past 7 years. And even in the last quarter, the fossil-free CanGlobe fund was able to outperform by over 1% in the quarter against the benchmark. And then our fossil-free institutional balanced composite. So this is a compilation of our balanced fossil-free clients that are institutions against its benchmark that is also a compilation of their benchmarks for each of these individual clients. And over the past 7 years, almost 7 years, we've been able to outperform the benchmark here as well, having a 6.2% annualized return versus 5.7 about annualized return for the benchmark.
So before we close, Mike, how has this global pandemic really changed the landscape for fossil-free investing and sustainable investing?
Well, I think for around the world in every sector, people are looking at risk differently now. They're realizing that there was a lot more risk out there than people were really accounting for, and not only risk around health scares, but also risk around oil and gas. And we think that these fossil-free funds, especially the impact fund, are really a hedge against kind of oil and gas related risk and climate change risk. So we think that people are going to be looking more into these strategies in the future, especially when they see how well these strategies have been able to perform over this time period.
Okay, well, thanks, Mike. That was our sustainable and fossil-free first quarter review. And we hope to be back next quarter. Thank you all.